Good evening, everyone, and welcome to the Journey to Multifamily Millions monthly webinar. It's been a little while since we've done one of these, but I am back and I am your host, founder and CEO of Zana Investments, Tim Little. We help people diversify away from the volatility of the stock market and get competitive returns by providing them the opportunity to passively invest in multifamily real estate. And some general housekeeping rules. Please keep yourselves muted when not speaking. If at any point you have a question, please just drop it in the chat and we'll address it during the Q&A portion. During the Q&A, you can also raise your hand and I'll go ahead and call on you and you can unmute and all that good stuff. All right. And just so everyone knows, this is being recorded right now and I'll send it out as soon as it is available. Finally, I encourage everyone to go ahead and put their contact information in the chat so you can build your network with like-minded folks. And with that out of the way, I'm excited to get into the presentation. Tonight, we have with us Adam Sypniewski. Adam is a managing director with Midland Trust, and he is going to break down for us self-directed IRA. I have my own experience using a self-directed IRA, but I don't want to give any spoilers. So Adam, I'll go ahead and pass it over to you so you can take it away.
Great. Thank you so much, Tim. I'm delighted to be here. I really appreciate you having me on and excited to talk to you and to the audience about self-directed IRAs, something that is a subject that maybe a lot of people have heard of, but maybe you don't know a ton about. And I'm excited to present a little bit of a slide deck here for the audience today and welcome you and anybody to answer questions and hopefully consider me a resource as we go throughout the presentation. And as more importantly, as we get away from the presentation, Tim, if it's okay, I'll start sharing some slides here that might help us go over this self-directed IRA idea. Let's talk about what is a self-directed IRA first. And I think it might be more important to unpack what is an IRA. IRA stands for Individual Retirement Arrangement, or Individual Retirement Account is what it's more commonly referred to as. But the specific part of it is individual. So this is not a group plan. This is an individual account where each of us as American taxpayers can have this sort of retirement account that we're using to build our wealth for retirement. When we use the term self-directed in front of it, it's more or less a marketing term. Self-direction is not a tax status. It's not a specific type of plan. It's really to communicate what you're doing with your IRA. And when we talk about self-directed, that means that the account owner themselves is picking and choosing investments to hold in their IRA. So that's the first thing that I want to communicate to the audience here is that this is not something that you have to make sure you indicate or open up specifically at Fidelity or something like that. You can self-direct your traditional IRA, which you've probably heard of, that most of us have, or that we've rolled into from an employer plan, which we'll unpack here later in the presentation. You can self-direct your Roth IRA. You can also self-direct your SEP IRA. You can self-direct your solo 401ks for our business owners out there. And you can also self-direct some other savings accounts like education savings accounts and health savings accounts. We're not going to talk about that tonight, but more importantly, self-directed IRAs are a style of IRAs, a philosophy of using your retirement account towards specific types of investments. And self-direction itself is directing towards private investments, Tim. So that's the first thing that I want to impart on the audience. Self-directed IRAs, it's really to communicate this thought that you're using your IRA to invest in something private or non-public. So when you talk about diversifying your investment portfolio away from the stock market, that's exactly what self-directed IRA investors are doing with that account. So they might have a standard IRA at a Fidelity, at a Schwab, or something like that, Tim. But what they do with a self-directed account is they take a piece off of their general IRA, their standard IRA, bring it over to a self-directed style custodian and invest in something private, like a multifamily deal, like a real estate fund. Maybe it's direct real estate themselves, but that's really who we're here to help, is those that are looking to invest in private investments. And so now that I've communicated that, I will go ahead and share my presentation and we will get into this. Let me get into presentation mode. Okay. All right. I talked a little bit about a self-directed IRA, but who am I with? Midland Trust. We are a qualified custodian. We hold self-directed IRAs. We also serve as a QI, a qualified intermediary for 1031 exchanges. Some general facts about us, but I don't think that's too important. main things that I have some experience, and we as an organization have a lot of experience helping real estate investors and tax strategists do real estate deals with these strategies in mind. And just a disclaimer that I probably should have said at the top, Tim, is that I'm an educator and someone who's raising awareness about IRAs. I am not an advisor. I'm not a fiduciary. So I'm not here to provide specific investment advice. I'm merely here to present this material and educate the audience about self-directed IRAs. So again, what is a self-directed IRA? I got into this at the top. Again, just a marketing term, and we can self-direct all types of retirements and saving and some types of savings accounts. But all these IRAs can be self-directed. And what it means, again, is that we're investing in something private, something off market, like real estate, like lending, things like this, that, can't be publicly traded on an exchange. And here's one point that I wanted to make as well, additionally, Tim, is that third or fourth bullet down, the unlimited choices. There's only really two things that you can't invest in, which we're going to get into. But this matter of who, not what, when it comes to what we can invest in. So that's one thing that I want to get into later in the presentation when we talk about what types of investments can we get into. So in a later slide, we'll unpack that, Tim. But right here, we're talking about what are the advantages of using like a typical IRA at, say, a Fidelity or Schwab versus a self-directed account. Yeah, Tim, go ahead. Okay, so here we got into what is a self-directed IRA. So again, not to rehash this the third time, but all the points that I made previously are here in bullet form. So this is where you stuck up your hand, Tim, and said, hey, we're not seeing things. So the advantages of self-directed IRAs versus what we call banks and brokerages here on the slide. Banks and brokerages, what we mean, folks, is Fidelity accounts, Schwab IRAs, things that most of us know where we have our IRAs, are the bulk of our retirement portfolios. Both of them offer the same tax advantages. A self-directed Roth IRA is just like a regular Roth IRA. It's the same tax treatment, right? Same tax rules, same 5-year bucket, same basis. It can be taken out without penalty, all those things there. So tax advantages are really the same. Where the difference comes into play is really, again, what you invest in. Those traditional banks and brokerages are going to limit you to a curated list of investment products like mutual funds, equities. Maybe you can do some other slightly exotic things, but you're completely exposed to the market, and that's where you're limited. Whereas with self-directed, there is ways that you can hold a brokerage account within your self-directed account and sure invest in the market that way. But it's more this power of true diversification through the power of real estate, through the power of other alternative investments that we as investors are familiar with and believe in the returns that they're going to generate. And that's what self-directed IRA investors are seeking with this type of account, with this type of strategy. Any of the fees, that's nothing really to unpack there, Tim. Everybody knows what we're dealing with self-directed accounts, though. We don't typically, a lot of providers aren't going to charge you anything on performance because, again, we're not brokers, we're not advisors, we're not fiduciaries with self-directed accounts. You are your own fiduciary. So we're not going to charge you a commission on performance. We're not going to charge you anything like that. It's related to what you're investing in because we're not choosing nor promoting those products to you. You're here to make those calls. So we're not here to take a cut of that return. Here's one of the questions that you teased when we were talking about the presentation, Tim, was how can I get a self-directed IRA or who is eligible? Anybody really is eligible for a self-directed IRA. There's not like an accreditation requirement or anything like that. You basically have to have the portable retirement account with the ability to self-direct it. And what I mean by that, Tim, is a portable retirement account. Let's unpack that for a second. It's really, when we talk about a portable retirement account, that's something that's not stuck in a plan. A lot of us have employer plans through our jobs. Most of us W-2s have a 401k. Some in some other sectors have a 403b or a TSP, perhaps. Those plans are typically subject to your service in the plan, your activity in the plan, meaning if you're under 59 and a half and you're actively working for whoever sponsors that plan, the employer, you're not going to be able to roll over that balance. So when we talk about what's portable, it's when those old 401ks, when we've had a separation of service, when we're over 59 and a half. And that bucket of money is the most common way we see folks setting up a self-directed IRA and investing that cash. They've accumulated a balance through an employer over a number of years. They've maybe invested some target date funds in their plan that they're investing like everybody else does. there comes a point where they want to do something more exotic, something a little bit different, something that they know and love, something like real estate, something like multifamily, perhaps. They would roll over that old 401k when they had a separation of service, or maybe when they reached 59 and a half, they'd roll that over to an IRA, and potentially a self-directed IRA if they wanted to. Again, there's no eligibility requirement. Tim, you or I could self-direct. As you said, you have a self-directed account today. It's really whoever. Self-direction is for those that know what they want to invest in the alternative space. Again, knowledgeable investors. So when we talk about the other ways we can fund an IRA, the most popular being that rollover from an employer plan, but we can also contribute via transfer from an existing IRA. Again, that comes back to that portability question, that portability subject I brought up earlier, Tim. IRAs in their nature are portable. We can move IRAs from one custodian to the next. So we can move them between Schwab, between Fidelity. We can move that cash, those assets between IRAs, and there's no penalty. There's no limitation on that. It's called a trustee to trustee transfer. In a legal sense, it's an IRA to IRA transfer. You're just putting your assets from one bucket to another. There's no tax liabilities created. So again, IRAs are portable. Old 401ks are portable and also become portable when we reach 59 and a half. And then the third way that we see IRAs funded are via contribution. I don't bring that up very often during these presentations, Tim, because we're only limited to $7,000 a year that we can contribute to an IRA. And most of these private placement type investments are going to be accredited only offerings, or maybe they need an investment minimum of 50K, 100K, something like that. And not many people are going to be able to accumulate that balance by contribution alone. So for those listening, make sure you're taking advantage of those employer matches. And if you're a W-2, you want to get those plans accumulated, because again, imagine the balance that you're going to accumulate and be able to roll over into a self-directed IRA that you can then invest in a deal that might yield you 10, 12, 15 or greater percent returns. So far, so good, Tim. Is this all making sense? And is the presentation still fitting? Is it still landing with you?
Yeah, and I think you bring up some really important points that I just want to launch off of. You talked about how it's these old 401ks, and I think a lot of people just don't really. A lot of people forget about them. Let's to be honest, because they're on autopilot after you leave your employer, they just continue to be invested in whatever they were invested in when you were there, and so
Yeah.
people just forget about them sometimes. And I think this is becoming more and more common, especially with the culture around work today. And there was a time way back when people used to stay at companies for 10 or 20 years. That is not the case now. And in fact, you're losing money if you're staying at a company for more than 2 years, because they say now if you don't switch companies every 2 years, you make like 50% less than the person who does. So if you think about that for a second, if everybody is switching employers every 2 to 3 years, think about how many orphaned 401 are just sitting out there doing nothing, or sitting in exactly the same ultra conservative funds, like you said, target date funds, which are targeted for when they will retire. And what if that person is 35, 40 years old? They're not retiring anytime soon. So those funds that they have that money invested in is probably way too conservative right now, when they could be getting a much better return on something like real estate or something like that. So there's that one aspect, just the sheer number of people that are in this situation. So hopefully some of them are listening and they're like, oh, wow, I'm in that situation. The other group is military folks, right? Because most people in the military don't stay in for the full 20 before they get out. A lot of folks, they do their 5, 10, maybe even 15 years, and they get out, and they had a TSP while they were in. Again, same thing. That retirement account, it's sitting in either like fund A, B, C, or D, right? We don't have a whole lot of options in the TSP. And so there's another huge opportunity for all of those folks who got out of the military and haven't done anything with their TSP that's just sitting there. Same for government workers, right?
Mhm.
And their TSPs as well. They can take it out, roll it over, and invest it in, I won't say whatever they want, because there are certainly limitations, but have
Mhm.
much greater control on their investments.
That's a great point, Tim. And yeah, you bring up a good point that, like, with the old balances, those old delinquent orphaned 401ks. Remember in the pandemic, there were people that had 2 and 3 jobs, right? And they were probably accumulating small balances. And I will also make the point that if there's anybody in the audience that takes a listen to this that might be a deal maker themselves and not just an investor, but maybe you're looking to raise money to invest in a larger type deal. You're trying to scale up your deal and try to bring in other people's money. Think about their IRAs as a capital source. Think about their delinquent 401ks, because a lot of them, as Tim said, left it and forget it. And it's just sitting there getting fees deducted until they realize that balance is sitting there in a qualified account and they haven't rescued it out of there yet. So just a point I want to make. Also, Tim, on the eve of Veterans Day, I do want to thank you and all the veterans listening. Thank you for all that you have done so that we can do what we are free to do. I will never get tired of thanking folks, our veterans like you that have done that. So thank you for that. I do want to make sure that I fit that in, as I know that we're recording this on November 9th.
Yeah, thanks, Adam.
Absolutely. So we're moving right along here about who's eligible for a self-directed IRA. What is it? Let's talk a little bit about choice and what we do with those accounts. As Tim mentioned, we can do multifamily real estate. We can be a passive investor in a deal. A lot of our clients do that here with our self-directed IRAs, Tim, but they also can be active investors. They might landlord. They might own a single family home. There's a lot that we have seen our clients do. They might be lending. They might be investing in a startup company, in a new business, a tech startup. Obviously, precious metals is a tangible asset like real estate that a lot of Americans know and love and want to continue to invest in. We see that. But you'll remember earlier in the presentation, before I corrected my slides, I made the point of it's not so much what, it's not a matter of what you invest in, but who. And I say that because there's only 2 investments the IRS says you cannot invest in. That's collectibles. So things like baseball cards, vintage bottles of wine, sports cars, things that are rare and collectible. The other asset that we cannot hold directly in our retirement accounts, life insurance policies. So collectibles and life insurance are the only 2 assets that the IRS says we cannot hold in our IRA. So everything else is eligible. They don't specifically prohibit any other assets. So it's really like the world is your oyster. If you can create a paper trail and it doesn't create any sort of prohibited transactions, perhaps we can find a way to get that into a self-directed account. Okay, Adam, so why did you say it's not what you invest in, but who? The IRS does have a very specific list about who you can invest with when it comes to your IRA. We'll get to the list on the next slide. But just a broad idea for the audience is that the IRS wants you to use this vehicle for retirement, for wellness in your retirement, to build wealth for retirement. They're not looking for you to enrich yourself now personally. And so there has to be this arm's length transaction understanding when it comes to your IRA. And what that means is that you can't self-deal or do something that personally benefits you with your IRA. So the way the IRS tries to legislate against that is they have a list of what they call prohibited parties. And that's what you'll see on this list here, folks, on this graphic is prohibited parties. So when it comes to your own IRA, this is the list of who your IRA cannot directly transact with. So when you're talking about making a loan to somebody, when you're talking about landlording or something like that, or maybe you're a GP bringing in LPs or something like that, these are the people that would be prohibited to your IRA. So if I'm the IRA holder with my fancy beard and my redheaded spouse with a top knot there, both myself and my spouse are prohibited to my IRA. Also going down my family tree, my children, their spouses, my grandchildren and their spouses, also prohibited to transact with my IRA. Also going up the family tree. So my parents and spouse, my parents, and then my grandparents. Those are the prohibited parties. So you think about it, it's all up and down the family tree, Tim. It's lineal, ascendants, and descendants. Noted, they don't say anything about lateral family members. This is where we get into some legal gray area, and clients can ask us, hey, can I invest with my uncle? Can my cousin be an investor? Can he rent my house in my IRA? Things like this. We always say refer to a legal advisor, a CPA, because again, we're not fiduciaries here. But again, in a general sense, you can't invest with anybody up and down your family tree, yourself or your spouse. That's like a rule of thumb. I think this was just one point I wanted to hit on in the presentation, Tim, is that a lot of, again, what we see and a lot of who we serve here at Midland Trust are passive investors. particularly when it comes to the IRA. It seems you made the earlier point with 401ks that people forget about these things. Passive investments through your IRA, we don't see a lot of active investors using their IRA. It's a long time horizon, Tim. So a lot of these investors have a set and forget philosophy. So when it comes to those that are looking at real estate investments, maybe you're having some liquidity issues, or with inflation, you don't have as much investable capital lying around. The point I wanted to make earlier is that I think there's some sort of stat, and don't quote me on this, Tim, but I think it's a figure around 70% of an American's investable wealth is within a retirement account. So for those of us that are feeling this inflation pinch and maybe can't access the deals or don't have the scratch to invest in deals that we know are good deals, especially when there's going to be buying opportunities coming up, think about your retirement account as another capital source to access these types of deals. Maybe you don't have 50,000 lying around right now, but guess what? If you've been contributing to your 401k and rolled that over to an IRA, I'm going to bet that you have six figures in there, and you might be able to liquidate a portion of it to get into one of these deals offered by Tim and others. So just another way to think about how you can approach and access these deals that maybe you're thinking, hey, Tim, I don't have enough money right now to get in on this deal. It looks great, but I just don't have the scratch. And then one other point that I'll make about private investments and private placement, syndication, and the like, depending on what type of offering the audience might be looking at, they might need accreditation, or they might need to be an accredited investor. And I just wanted to make the point that your IRA does not need to be its own accredited investor. If you are an accredited investor, your IRA is one of those as well. So before I get into the home stretch here, Tim, any other questions or items or points of clarity I can make before I get through the last 2 or 3 slides here?
No, just going back to real estate syndications, since that's one of the aspects that I do have experience with on both sides. As a matter of fact, as an active syndicator myself, I have taken investments that were from people's self-directed IRAs, and it could be a really smooth process. And you're right. It's like me personally, I do have the set it and forget it mindset because I know I can't touch it anyways. So it's not like, ooh, can I get it back now? Like that, it's not going to be the case because what is the plan? As soon as that deal goes full cycle, I'm just going to reinvest it into another deal. And that's exactly what I've done. I have a solo 401k, but that's really just another form of self-directed IRA, which I used from a TSP that I had and rolled it over, right? And the first thing that I did was I invested it in a real estate syndication deal. And I think it was $50,000 was the minimum. That's what I put in. And during COVID, doubled my money in less than 3 years. It was amazing. I couldn't touch that money, but that's not the point. It's still growing for my retirement. And then I took it and I was even able to lend it out like a hard money lender using that account. And that probably blows some people's mind, but depending on the type of account that you have, you can actually have checkbook control. And as long as it's an approved way of using the money and you never touch it, then it's all still above board. And then I invested it in another syndication deal. And I'm going to continue to do that until I legitimately retire and am able to pull that money. But it is really nice for those who are passively investing, because like you said, they may think that they're tapped out from a investing perspective because it's not easy to have $50,000 or $100,000 cash on hand, right? Just sitting in your bank account. But when people look into those retirement accounts, they may see, oh, wow, yeah, I forgot because I was putting money away every month and my employer was matching it. I didn't realize I had 50,000, maybe even 100, 200,000 in that account. And that's money that they could be putting to work. And again, the tax benefits are not as relevant in this scenario, but still the returns are. And I think another important point that we didn't talk about as much is the diversification piece. If you've moved on to a new job and you have a 401k there, I promise you it's all going into the stock market anyways. So you need that diversification. And this is yet another way that you can do that.
Yeah, no, that's a great point, Jim, and love the use case. And that's a great point that you make that, hey, you invested in one deal and double your money. I think one point that I'd also make is this is not a cash flow strategy, folks, either, because I know a lot of times we're looking for mailbox money and things like that when it comes to real estate, that any dividends are going to, the cash is going to, any income produced proceeds are going to flow back into your IRA. So yes, it'll flow, but you can't access it until, like you said, retirement age. So if you're getting that growth, that value, that's great. Any cash that's going to accumulate is going to stay in that IRA as well. So all good things when you're getting a high interest rate environment as well.
Yeah, no, that's a good point for people who are vetting deals, right? I probably wouldn't worry as much about the cash on cash as I would the equity multiple, which is how many times your money are you going to make over the life of that deal? Will it 2x? In other words, double over the course of that 5 to 7 years? If so, then that probably makes a lot more sense than looking at how much cash it's going to kick off on a regular basis. But like you said, it still keeps going right to that account anyways. So it'll still be there, but different prioritization, I would say, as you're vetting these deals, if you are investing specifically with a SDIR.
Yeah, exactly. And some of these points that are on the screen, Tim, we've already hit on, but it all bears repeating. As you mentioned, this is true diversification away from the public markets. Because like you said, if you roll over your 401k into the new 401k with your new employer, it's still the same basket of publicly exposed securities and the like. So that's really, I think, the most common reason folks open up a self-directed account is they want true diversification. They want to invest in their community. They want to invest with a sponsor they've earned returns from previously. They just know that they want to diversify away from the market. They don't like what they see, or they're just more familiar with the real estate investing. Obviously, we talked about the job changers and those delinquent balances, those orphaned retirement accounts. They want to put those to work. This is another reason people might use their IRAs, because they just have that portability that we talked about. Also, I mentioned this earlier, is the illiquidity. It is hard to accumulate cash and have cash on hand to participate in a deal when there might be a tight close or something like that. A lot of times, IRAs are the way that folks can get into deals that they know that they really want to get into and might not otherwise have the capital to do. Obviously, there's a tax mitigation strategy here. I'm not a tax advisor. I'm not a CPA, so I can't take you through too many scenarios there, folks. But the biggest thing is that we're using a tax sheltered account. So things like cap gains don't apply. We also can't write off our losses and things like that. It's a tax sheltered account. So you have to think it's its own entity that you can't apply. You need depreciation, things like this. Again, I'm not a CPA, so I'm not going to play like one, but or make any sort of formal declarations there. But you can see where I'm going with this, that the IRA is its own entity that's investing here. And the last point there, I touched on this already. A lot of folks, what is it? It's know, like, trust. And that's who they invest with, right? You first have to know them, then you have to like them, then you trust them. A lot of times, that's how folks invest directly with somebody. They get to trust them, they get some returns. They say, hey, this is great. I'm getting cash flow. I'm going to put my IRA in this deal too. I want to put my IRA in the next deal with this person that I've trusted and earned returns from on their last deal, amongst others. But those are probably some of the most common reasons we hear folks set up an IRA. To wrap up, just some tips or things to consider if you want to go down this route, folks. You need an IRA custodian like a Midland Trust or someone in our space. This isn't, while it is self-directed, you can't just go and do this on your own. You need that legal entity known as a custodian / administrator in some cases. Just that second bullet point is the case there. These investments, for those of you that know subscription documents or operating agreements, if you've ever invested, you use your social security number on those documents. When you're using your IRA account, you're going to use the EIN of your custodian. That's where the in the weeds point that keeps our tax shelter in place. So things like that you can't do unless you have a custodian. You mentioned checkbook control, Tim, as well. That's something that kind of gives you a little bit more of a kind of a shell to do a lot of more investing through the retirement account for those that might be a little bit more sophisticated and know what they're doing from a paperwork perspective. But the same philosophy applies. You want to make sure that you have an entity that can advise you and guide you if you're going checkbook control. While it is a hands-off thing from our perspective, and the investor is doing a lot of paperwork, as long as you have that resource you can turn to, I would suggest that's important for the audience. So if you're going to set up checkbook control, if you're going to self-direct, just go to a place like a Midland Trust or somewhere else that knows what they're doing. Again, cash flows, we talked about this earlier. It's not coming to your mailbox. It's got to go back into your IRA. So if you're taking those dividends, those returns to your personal bank account, when your IRA is a subscriber, that's a taxable distribution, and the IRS is probably going to come knocking at your door. So again, these are why we need to engage a custodian, so a legal entity to make sure that it's reporting and safekeeping on our behalf. Other points that I'd make: the lead time to do something like this. How long does this take, Adam? If I have an IRA or if I have an old 401k and I want to get into Tim's deal, how long will that take me? Usually about a week to 2 weeks. I give us another week there, just in writing to give us a little bit of wiggle room. But usually, folks, if someone's doing a private placement, a multifamily syndicated deal, an LLC, and a partnership, something like that, we average about 10, 11 days from IRA setup to investment made. So if you're working with somebody else, it shouldn't take you longer than 2 or 3 weeks to do any of this. And if it does, then I would maybe suggest finding some other solutions, because there are quicker ways to get it done. And again, we touched on this active 401k. If you're under 59 and a half, if it's an active 401k, chances are we're not going to be able to access that cash, as Tim mentioned. So how do we get started? I put it up there. It's really when you folks know you have a deal you want to invest your IRA in. I think that's the biggest point that I want to make in closing, Tim, is that we are not a shopping mall. A self-directed IRA provider is not a mall of investments. It's, again, a self-directed account. So when you have a deal, or you know that you're eyeing a deal that you might want to invest your IRA in, start getting that self-directed account set up at that point and not before. Because a lot of times, especially in Midland Trust case, we only do the private investments. We don't hold Amazon stock or mutual funds or anything like that. So any money that's not being put into a private deal is sitting on the sidelines, not really being put to work for our client. So we say, once you have a deal in mind and you're within 8 weeks, 6 weeks of closing, we should start talking and getting that account set up, but not too much earlier before, because you might be missing some easy cash, especially in these high interest rate environments. But last point, everything is pretty much done online, folks. We've gotten really streamlined with this, but I offer myself as a direct resource, whether it's any of the information in the presentation today, if you're looking to get set up with an account, or if you just have general questions. I do welcome any opportunity to help. So Tim, that's really all I had from a presentation standpoint. So I'll stop the share now, if that's okay, and open it up for any questions and your comments, of course.
Yeah, and I just wanted to ask a quick question. You talked about people not getting these set up until they have a deal that they're eyeing. Can you just explain to me a little bit more? Would it not? You don't want the money to just sit in the account, right? Just idle is basically your point. Is that right?
Yeah. So like self-directed custodians, like a Midland Trust, we only hold private placements. We only hold promissory notes when folks are lending to another. We don't have the capacity to hold a public stock or a money market vehicle directly in our accounts. So if you're bringing $50,000 to us to invest in a deal with Tim, you can invest that 50,000. It's going to sit in 50,000 cash, not earning a cent until they send it to you, until we send it to Tim. So that's what I was trying to communicate, is that wait till you have something in mind, because we're not going to bring you deals. We're not going to suggest deals to you. Again, it's that we're not a shopping mall, is the other side of that argument. Or the other point that I needed to make there, Tim, is that we're not here to provide you deals or present any sort of opportunities to you. You need to have found that yourself. In terms of the IRA investor, you have the deal in mind. You have the opportunity in mind. We're the vehicle that we're going to set you up and get you into that deal as quickly as possible.
Okay, I guess just so I was thinking from the perspective of someone decides, hey, this is what I want to do. I want to start investing my funds into deals like this. Let me go ahead and get this set up. That way I'm ready to move as soon as I find a deal that I want to invest in. That's just as legitimate, right? Like, even if it winds up sitting for a month or two until they find that one that they want to invest in.
Yeah, absolutely,
Okay.
Tim. And yeah, a month or 2 months, that's great. I'm more or less saying folks sometimes will call us up and say, hey, I want to start self-directing, and they'll open up the account and expect us to bring them deals and things like that, or
Yeah.
that they're going to come online and see all the multifamily syndications or all the private equity deals that we've held. And that's just not the case.
You're not a
prohibited.
clearinghouse for
Exactly. Yeah, exactly. We have no investment products ourselves. No firms really should in our space. That's all that I mean. That if you're someone who is obsessed with your cash always working for you, you'd want to wait till closer to deal time, that you have something in mind, rather than just setting it up and, I'm going to wait a couple of years until something comes by, because you're going to miss that 5% rate that you're getting on your cash right now, because we're not going to pay that out.
Okay.
No custodian really is.
Sure. I got it now. And I guess there's different like legal formations for this stuff, right? Like my solo 401k may be like a special snowflake in that I know it's legally a little more complex, which is what gives me the checkbook control and also allows me to borrow from it without penalties. Is that something that's restricted to solo 401ks, or is it just a matter of the legal structure under which it's housed?
Yeah, that's a great question, Tim. So you can borrow against a 401k. You cannot borrow against your IRA. So that is a very important point to make. That's not in the presentation here. Solo 401ks, like there's certain eligibility that comes with that. And that's because you're self-employed. And depending on the number of employees that you might have, there's certain rules that come up with a solo 401k and a SEP IRA. But again, those are the nicer plan, what they call the Cadillac plans, because you're able to contribute more as an employer in addition to being an employee in the case of a SEP. And then, yeah, with the 401, with the solo 401k, because you have no other members in that plan, you can do things like lend to yourself. You can do things like shelter your investments from UBIT and the like. That's another presentation we can get into. For those listening, UBIT is a very often misunderstood tax that can generate in our IRAs. It's a very, it only comes up in the case of like leverage and things like that. Tim, I don't know that we want to uncover that whole ball of wax. That might be a better offline conversation.
Yeah, that's going into the weeds for sure. So maybe we'll do an advanced version of this another time. But yeah, I know where you're
Absolutely.
going with that.
Yeah.
But no, I appreciate you clearing that up because I wasn't sure what that difference was. But it sounds like, yeah, the solo 401k and I guess the SEP IRA are the ones where you can borrow without a penalty. And there's even limits to that. In my example, it's up to 50% or $50,000, whichever is lower. Yeah. I'm probably not putting that eloquently, but
Yeah.
$50,000 is the max that I can borrow. Or if any number lower than that, 50% of what's available. So if I only have 50,000 in there, guess what? I can only borrow 25,000
Mhm.
just to give people an idea. And it, like you said, there's pluses and minuses to these different types of plans. You mentioned some of the positives with a solo 401k. Some of the negatives are that I can't hire any full-time employees under that LLC for which that plan is associated. If I do, I wind up, I don't know, nixing my status.
Yeah, your eligibility goes away. Yeah. Mhm.
Thank you. That's the word I was looking for, eligibility. But like you said, there are certainly some positives too, just in terms of the flexibility. And I'm not going to say there's ways around the negatives, but you can hire virtual assistants and stuff like that to still build your business without necessarily hiring full-time employees. But
Mhm.
just something for people to think about.
Yeah.
And you can correct me if I'm wrong. The only real requirement is that you have an LLC. If you have an LLC with an EIN, then you should be able to start a solo 401k. Is that an accurate statement?
That is an accurate statement, Tim. I would say yes. And you need to be the manager of that LLC was the other
Mhm.
stipulation. It needs to be your LLC owned by
Yep.
you. Was the other stipulation. I won't get too much more defined than that, but you give a great perspective, Tim, as a business owner and someone who's done this before. When you talk about adding employees, those are conversations I don't get to have very often because you're right. Like you're scaling your business and don't want to hinder your ability to your plan, your solo K plan. You don't want to hinder that eligibility. Those are great points that I'm sure our clients would love to hear some more of that stuff too. So I think we might have to have another conversation as well in the weeds from your perspective.
Yeah, and to your point about what we were talking about earlier with the shoot, what was it? Oh, so we talked about borrowing from the banks and the need to. Well, I was going to ask you, do they need to invest the full amount that's in the account, or can they diversify that into multiple deals?
Oh, yeah, that's a great question, Tim. And yeah, this is not an all or nothing
Okay.
proposition. So even with an old 401k, say, you worked a gig for 10 or 15 years or whatever, W-2, you built up 100K in an old 401k, you left that job. You don't take that. You don't have to take that whole 100K to your new 401k. You don't have to take it all, roll it all over into one IRA. You could roll over a piece into one IRA to self-direct and then 50K of it to Schwab to put in, I don't know, an S&P 500 index or something like that. and then take that other 50K to a different custodian to self-direct. And then even when we get to that, Tim, you could chop it up further than that. If you rolled over 75K to self-direct, you could put 25K into 3 deals. Again, it's like holding multiple investments. But I think the biggest point you were trying to make is that you don't have to take the bulk, the aggregate of your retirement account and put it all in the same bucket. Once you have that portability, you have a separation of service for a plan like a TSP, like a 401k, you are free and clear to do, what you want with it in terms of getting it into one or multiple subsequent qualified accounts.
Yeah. And I think the other thing I was going to mention, you were giving yourself a little padding on the 2 to 3 weeks to get accounts spun up. I've seen it happen faster than that. So thank you. But the other thing is just, I guess, the ease of use for folks who, especially, are busy professionals. They do not have a lot of time. They
Yeah.
do not have the desire to get into the weeds on how to do this, to fill out the forms and all that
Mhm.
stuff. You guys make it very easy. You do all the heavy lifting for them, side here from their perspective, but otherwise, you handle it from the point of rolling it over to actually getting the documents filled out for their investment, which
Mhm.
I think a lot of people may not realize. They may think of you as, hey, yeah, you set it up for them and then it's on them. But in terms of allocating that money to the deals, you actually do a lot of, I don't want to say hand holding because that sounds condescending, but
Yeah.
some people would probably take it because, yeah, they don't feel like doing it themselves. You do a
Yeah.
lot of service in that regards as well. Can you talk about that?
Yeah, no, I appreciate you mentioning that, Tim. Yeah, as far as Midland Trust goes, yes, we do provide a meaningful service by people who care. There are human beings behind the scenes that are doing this. We're not. I have the pleasure of being shoulder to shoulder with a lot of bright people and human beings that are doing this work. So this is not like we're not an app on your phone. We are somebody who is going. We're a country club, more or less. We're gonna welcome you into our community as a self-directed IRA investor. Most of the time, we're gonna know what you invest in before you've even opened that account. Because we've talked to you beforehand and answered your questions, or you were referred to us by your investment sponsor. So we're going to have a good idea of what you plan to do before you're even opening an account with us. And as you said, Tim, after that account opening, that's where, you're already, assigned an account concierge, an account manager that's going to be working with you to coordinate your transaction for you. So you talk about investment documents, something like a subscription document or something like that. We take the liberty of filling that subscription agreement out for you for your IRA in the name of your IRA. And all you have to do is click to e-sign it, to read and agreed. Because again, harkening back to that one point I made, we have all the details. It's going to be an REIN and not your person's social, right? When we talk about how the investment is registered. Again, a little bit in the weeds, but it's important because we have those details and it's our pleasure to fill that out for you to make this as easy as possible. We know that alternative investing, real estate investing is a cumbersome process that we have for 20 years recognized, over 20 years recognized, and that we're, obsessed with making easier. Whether it's a private placement that, yeah, still have subdocs, or maybe you want to buy that single family home a couple blocks over because you know that it's just going to rip in value in a decade or two. We'll be at the closing table on your behalf if that's the property that you want to own in your IRA. We're going to fill out the closing documents, be title companies and things like that. When you talk about who Midland Trust is and the service that we provide, Tim, yeah, that's where our service, our value is delivered in terms of we want to make this what is quite often misunderstood and cumbersome process easy, delightful, and enjoyable for our clients, and most importantly, that they understand what they're doing every step of the way. Because we know a lot of times it's the first time that folks are going through this when we talk about self direction.
Yeah, and it wasn't a shameless plug or anything because unfortunately you can't give me any kickbacks or anything, but it was really just based on what I've seen with my investors. And obviously, if you make things easy for my investors, that's a benefit to me. So, of course, I'm going to recommend someone who makes their life easier because then it makes it easier for them to invest in my deals. But I have to find the investors, right? I find the investors. And if I recommend them to you or another provider, you're just helping them make that money more accessible to them so that they can invest it in the things that they want to invest in.
And we want to keep them from stepping in any landmines, right? We don't want
Yeah.
anybody to have any sort of undue tax liability. Some folks will just take a check out of their Fidelity IRA and turn around and send you a check, Tim, and think that if they filled out their subdoc in the name in the name of Adam Sypniewski IRA, that their IRA is subscribed. No, that's taxable distribution, and that's going to be a hard wake up call. So again, we want to make sure that folks don't step in anything here either. Want to make that point for the audience.
No, I think that's important because what we didn't talk about is what's the potential of doing something wrong when you fill out this paperwork. Because if you do it the wrong way and you wind up getting those distributions, that could cause a whole lot of headaches. So you certainly want to make sure, and I've gone through this myself, like having to double check with people as I'm investing with my solo 401k. Wait, I use this name, right? And my title is this, right? And I'm putting this bank account because I don't want it going to me, should only go to this bank account. Yeah, so that's super important because you don't want to violate that eligibility of those accounts. All right, Adam. So we're coming up on the end here. I'm going to open it up, give 1 minute to see if we have any questions from the group. I'll see if anybody raises their hand. All right. Doesn't look like we have any takers right now, but I think we got through a lot of great questions. So Adam, I certainly appreciate you being on. Hopefully you can provide me that PowerPoint deck. And what I'll do is I'll go ahead and shoot that out with this recording to everyone who signed up. That way they can look at it at their leisure.
Yeah. No, that would be great, Tim. I'll send it right over. Absolutely. I really appreciate you having me on. It was a great conversation tonight, and I'll look forward to hopefully becoming a resource for you and anybody else that might be interested about self-direction that joined us tonight.
All right. Thanks, Adam. Have a great night.
Yeah, you too, Tim. Thanks.
Bye.